Hey everybody, my name is Brandon. I'm with the research team, and today I'll be solo streaming. Guillaume and the team are at ETHCC. So if you're at ETHCC, please hit us up. We'd love to catch up and meet you, chat, and yeah, let us know. Just message us on Discord or Telegram, and then we'll be happy to arrange that. As far as today's live stream, we're going to be going over a very important topic: leveraging liquidity. And basically, today's live stream is really meant for those LPs, people who have experimented with LPing or who know a little bit about LPing, but want to take it up to the next level, want to make their LP strategies become better and more profitable and more like an options trader. And that's really the viewpoint that we'll be talking about, is how to view LPs a little bit differently today, in a different perspective. And that's what Panoptic does. It views LP positions as options. And because of that, it lets you trade things in a way that you've maybe never LP'd before. So hopefully today, this will be a tutorial from 0 to 100 of, you might have no LP knowledge at all, or you might have a lot of LP knowledge. But this tutorial will be geared towards you to help you trade better and to LP better and to think about these things a little bit better. So some of the questions, for example, that we'll answer are things like, what is impermanent loss? How should I manage impermanent loss? How wide of an LP position should I make? I have to choose a price range from this price to this price as an LP. What price range should I choose? What fee tier should I choose? There's so many choices. I don't know what to do on Uniswap LPing. And how do I hedge my LP position? These are very common questions that we here at Panoptic hear a lot from LPs, and hopefully viewing it from the options trader lens can actually help answer these questions in a very different way than you may have ever been used to or have heard of. So that is the perspective when you start to view things as a duality. Things have parallels, things have different point of views. And so when you start to look at the Uniswap LP positions, and here you see kind of the famous NFTs that they display when you mint a position on Uniswap V3. But when you start to view these a little bit differently, there's some similarities between this and this alternate options trading point of view. So we're going to go into that, and hopefully your worldview will maybe it'll change, maybe it won't, but at least you'll have some more tools to think of LPing a bit differently and hopefully improve your LPing. So disclaimer, nothing to say here is financial advice. Please do your own research. So LP basics. We're going to start with the basics. So it doesn't matter if you've never LP'd before. This tutorial will help you understand a bit better. And if you are a bit more advanced of a user, hopefully this part you can just skip along to the next part if you're watching this as a recording. If you're watching this live, feel free to comment on YouTube or Twitter, and we'll help answer any questions you have. But let's start with the basics of Uniswap V2 and V3 and even V4. So what is the difference between Uniswap V2 and V3? Very common question for those who have LP'd earlier on V2. They might be a little bit more unfamiliar with V3. But the whole idea here is Uniswap V2 was this kind of breakthrough protocol that lets you be able to trade. You could trade any token. You could swap your one meme coin for another meme coin, even when Binance wasn't available. And this was all enabled through liquidity provisioning. Now, the liquidity provisioning method was quite inefficient capital-wise. And so, for example, when people provide liquidity between the price of 0 to infinity on Uniswap V2, and that means people are providing liquidity at all possible price ranges. Now, how likely is it for ETH price to go to 0? How likely is it for ETH price to be at infinity? It's extremely unlikely, right? And so there's a lot of idle capital sitting around. So this is the main difference between V2 and V3. V3 introduced this concept of concentrated liquidity, where LPs could provide liquidity at a specified range and earn more fees by doing so, but also provide more liquidity, which means better execution prices for people if you want to buy meme coin A for meme coin B. So V3 introduces concentrated liquidity. You choose your price range. You can specify it yourself. You can say, I want to only provide liquidity between the prices of 2,000 and 3,000 for ETH, for example. All right, so you got to choose your price range. That's the main difference between V3 and V2. V3 is kind of a new model, an iteration of V2 that really brought capital efficiency, but also opened up a whole can of worms for liquidity providers because it gave them more options, more choices. Now you have more decisions to make. Where do I LP? What price range do I move it? If you go out of the price range, you stop earning fees. So lots and lots of different nuances between V3 and V2, but that's kind of the basic background there. As far as, so yeah, we'll go and show this on the UI. So Uniswap V2, for example, when you go and select your price range, you're going to see a historical price chart where the price, for example, of ETH has been, and then you're going to basically select the entire price range. So you're going to go provide liquidity from 0 all the way to infinity, full range that you see here on this UI image of Uniswap's app. The min price is 0, the max price is infinity. You're essentially providing liquidity across all prices. Now, as far as V3 goes, you can actually click and drag and select the narrow band of where you want to provide liquidity. So in this case, it's being provided around 2,363 to 2,686. So only about $300 price range is where your liquidity will be active. Outside of that price range, if the price moves above 2686 or below 2363, your position goes out of range, and so you stop providing liquidity. So that's the big difference, is you can actually click and drag this band on V3, select where exactly you want to provide liquidity. Whereas with V2, there's no choice. It's 0 to infinity. And V4, some of you may have heard of, been hitting the news recently. It launched earlier this year, and Uniswap V4 is basically another iteration of top V3 that generalized things. It brought hooks. You can kind of think of like from Bitcoin to Ethereum, how the Ethereum world computer kind of generalized and abstracted and allowed for more functionality than just sending and receiving a token like Bitcoin. It provided general programmable logic. So in a similar way, Uniswap v4 provides a bit more general programmable logic where you can insert custom logic into the pool logic so that you can do fancy stuff with some fun hook pools like dynamic fees, for example. So lots of room to explore here. We won't go into v4 today. We're just going to talk about LPing and how you can do that as an options trader, as is the name of this presentation. But we're going to talk about how you can step up your LP game, and this question sometimes comes up. So this applies to Uniswap v4 and v3, all of this material. Let's talk about the payoff of a Uniswap v3 position. Now, this is the part that trips up a lot of people. You may have heard a lot of things about how the Uniswap v3 positions works, but let's just break it down from a very simple kind of taxman perspective. Like the price moves up, the price moves down. If I were to withdraw my tokens from Uniswap, would I have made money or lost money? So we're looking at just the absolute payoff here. We're not going to look at impermanent loss for the moment or anything, or loss versus rebalancing or anything like that. So let's take a look here at the payoff of Uniswap v3 position. So we see that in this example, the ETH price is 2,500. And we're going to LP concentrated, because it's V3, between 2,000 and 3,125. Okay, let's say you start with 2,500 bucks, which is the price of 1 ETH right now. You're going to swap half of that for ETH. So now you have 1,250 in USDC and half an ETH. All right, and you're going to LP both those amounts into the ETH USDC pool. What happens when the price goes down? Well, here's what happens. Once the price reaches 2,000 or below, your LP position gets converted completely into ETH. So now you have 100% ETH and 0% USDC. So your position's totally in the risky asset ETH, which means, and the reason for that is because the swappers in the pool, they're selling ETH. Selling ETH pushes the price of ETH down. Your LP position is buying up the ETH, and so now you're totally just composed of ETH. Now, if you notice, the slope of this payoff line is -1. It's just a flat line that goes down and to the left. That's because as the ETH price drops, for every dollar the ETH price drops, your position is now 100% ETH. So it's going to lose the same amount or proportionate amount in value. And all the way down, eventually, so it just keeps going down at a 1-for-1 rate. So once the price of ETH drops below a certain point, you're losing 1-for-1 because your position is completely in ETH. The ETH price goes down $1, basically your position is going to go down about $1. Now, what happens when the price of ETH goes up? Let's take a look at that. So here, the price of ETH, well, we have to examine why did the price of ETH go up? It's because swappers in the pool were buying ETH. They want ETH. ETH's hot, price goes up. They buy ETH, which you're the LP position, you're taking the other side, you're selling them ETH. So eventually, once the price goes high enough above your 31.25 price range, your position is now composed fully of USDC. You're 100% USDC, you have no more ETH. So if you notice, the payoff curve here is actually flat. The reason for that is because now that your LP position is completely composed of stablecoin, it doesn't matter what the ETH price does. If the ETH price goes up and up and up, your position is just USDC. You don't make a penny more or lose a penny more. So your payoff has a slope of 0. It's just flat here. It means that your payoff no longer depends on the price of ETH because you're holding all stablecoin. So what happens in between? You can kind of imagine we connect the dots. It's as simple as that. We connect the dots. We draw a line between. It's a smooth curve, and then we see that here is our payoff of a Uniswap V3 position. We lose money when the price goes down. We make money when the price goes up, and then the price keeps going up. We stop making more money. Things just stay steady. Now, what does this remind you of? This payoff curve. Have you ever seen a curve that looks like this one on the right? If you have taken a class before on options, you may have seen charts like this. We have a long call, a long put, a short call, and a short put. There's puts and calls. These are the two basic types of option contracts. So as you see between the two images, which two look the same to you, right? So here we have LP position, and here we have different option payoffs. So if you said short put, you're going to be right, because this short put payoff looks very, very similar to the LP position payoff. So let's take a look here. Oh, so we'll go, sorry. Okay, yeah, so basically you have two very, very similar payoffs. What is the difference? They look very, very similar. But I did breeze through a little bit of the math. We were just kind of hand waving, drawing, connecting the dots here. But to be honest, there is some math behind this. In fact, there's a lot. There's this very popular Medium article by our founder, Guillaume Lambert. It's called Pricing Uniswap V3 LP Positions. And in it, he goes over the math of calculating the LP's values position and what happens in between that price range. And so if you're curious, you can Google search this article and it should show up as one of the top results. We're going to go look at this a little bit further. So there is a lot of math involved, very, very long formula of the difference. But that difference, when you plot it out, is pretty minuscule when you look at it with your eyes. It's hard to tell. So on the left, you have a normal short put or covered call. It's the same thing. Options payoff. And then on the right, you have the Uniswap LP position. In the middle is them plotted on top of each other. And as you see, the orange is Uniswap LP, and the blue is the short put. And what's being moved is how many days to expiring further out the position is, or how wide the LP position is correspondingly. But anyways, as you see, the positions actually line up very, very closely. They're almost the same. So we like to say LP equals options. Technically, LP equals options plus this really big long formula. If you want to learn more about that, look at panoptic.xyz/blog, and there's a big article about LP equals options that goes into this kind of subtle difference. But the key point here is that, once again, LP positions, they look very, very similar to option positions when we graph the payoff, which means we can do some fun stuff with it. But let's do a quick review of options, because some of you may have only LP'd and never optioned before. So let's go into the option 101. An option is an agreement between two parties for the right, but not the obligation, to either buy or sell an asset for a fixed price at a predetermined time. Yeah, that's a lot of words. So let's break it down this way. Let's say I have what should we use? A tungsten cube. Okay, I don't know what the going price is. So I'm sorry, I have no idea what the going price is. But let's say I want to sell you my tungsten cube in the future. For sake of example, let's say the current going price of a tungsten cube is like $1,000. Okay, I'll say I'll sell you my tungsten cube in anywhere from now till 6 months from now. You can cash it in. You can take me up on my offer, but the price that I'm going to sell it to you at is actually going to be $1,001. So you might think like, okay, well, why would I buy a tungsten cube from him for $1 more than the going price? Of course, you wouldn't, right? But the price might change. Suddenly, everyone might become wildly demandant of these tungsten cubes. Maybe someone tweets on crypto Twitter and goes crazy, and everyone wants this tungsten cube. Now the price goes up. Now you can get a better deal by buying it from me. Okay, so that's kind of how an option works. So there's a strike price. It's basically the pre-agreed upon price that you're going to sell or buy the asset for. In this case, the tungsten cube is $1,001. That's the strike price. The expiry is how long you have to make this kind of fulfillment. And that, in this case, is 6 months. I'll give you half a year to buy a tungsten cube from me. The premium is the amount that the option holder basically pays for this beautiful right to cash in at any time, or to take them up on the offer anytime. And because the option holder is not forced to ever actually purchase or sell the asset, they're not obligated to. They have the right, but not the obligation. So basically, they have the choice anytime to really do this. That means that you have to pay for this contract. I'm not going to sell you the option of buying my tungsten cube in the future for free. I'm going to charge you something. What the right price is has been debated for many decades, and then until the 1960s or 70s, when some mathematicians got together and figured out the actual formula for Black-Scholes and what you should price these things based on how far they're about to expire, et cetera, et cetera. And only then options took off. So basically, there is a formula called Black-Scholes that helps you price, get a good baseline of what you should charge for such an option. Should I charge $5 for this right, or should I charge $10 or $100? I don't know, right? I can plug into Black-Scholes, get a formula, and it'll show me how much the premium should be theoretically. So anyways, that's how options work. And in essence, the cool thing about options really stems from this right but not obligation. And the reason for that is because you have the right but not the obligation, you get a payoff curve that becomes curvy. It's no longer straight. It has a kink. It has a corner. It's bent. And this is because of the right but not the obligation. So basically, let's say you take me up on that offer. You pay me $10 for the right to buy a tungsten cube from me in the future. The price of tungsten cubes actually goes up. Let's say it goes up $20. How much did you make? Well, you could cash in that option, exchange it for tungsten cube for $1,001. You made $19, but you paid $10 for the premium. So in essence, you made $9. That's kind of how the options work. So hopefully, some options 101. If you want to learn more about options, you can check out our docs page, docs.panoptic.xyz. We have some really good beginner 101 materials. But I do want to just provide like a basic kind of outline there. So LP positions are a new kind of option. Back to LP positions and how they look like them. They are very similar to options, but they're not exactly the same. They're a new kind of options. Here's how they're different. One, LP positions are perpetual and never expire. Two, LP positions are ranged. They only get premia when the price stays in between a price range. The pricing is path dependent. So this is the third difference. LP positions don't necessarily follow Black-Scholes, but in some simulations we've ran in our white paper, prices do converge. Fourth difference, the pricing does not involve counterparties or market makers. So this is really a big difference. The pricing is protocol kind of determined by these Uniswap pricing algorithms and fee algorithms, and it's really dependent on the flow of volume coming in, which has some cool side effects, which we'll go into later. Fifth main difference, no Vega. The premium of an LP position is not affected by volatility expansion. I won't talk too much about the Greeks. If you know this stuff, you'll know it, but if you don't worry about it. Sixth difference, user-defined numeraire. Normally in options trading, everything's like dollar-based or euro-based. So you're trading S&P options, it's the USD price, for example. The cool thing with LP positions is a lot of things are priced in terms of ETH, which means you can trade the Bitcoin ETH price peg or Bitcoin ETH price target. You can trade things priced in terms of meme coins, right? So lots of fun new markets really from LP positions. The major difference between LP positions and options is that there is no way to buy an LP position. Even though it's like selling an option, there's no way for someone to buy it. So big difference there. Perpetual options. So I want to dive into a little bit more about how we can think of LPs as a perpetual option. Well, LPs as perpetual options could be thought of as like a normal expiring option. We call these vanilla options. They're just normal options. They're not exotic. Let's say the option expires in a month from now. You buy the option right now, 12 seconds later, you sell it, and then you buy another one that expires a month and 12 seconds from the original time. You do this over and over and over. Every 12 seconds, you sell the option and you buy the same expiry option, and that means it just rolls forward continuously forever. And the amount that you receive as premium is going to be the difference between how much you're selling for and then rebuying it for every time. So this is kind of like the LP fee that's getting generated every time. Why 12 seconds? Well, LP positions, the blocks on Ethereum are 12 seconds. This could be 1 second on Base or Unichain, but just as an example. So this might sound really similar to perps. It's basically an option that's getting rolled forward continuously. And yeah, that's a good way to think about an LP position as a perpetual option. Now, you might step back a little bit and say, hey, why do we even care about options? Like, there's these LP positions. They're kind of this weird thing that people don't really understand all the time. Let's just trade. Let's just buy or sell ETH. Who cares, right? Well, a lot of people actually care. The whole branch of options and perps and stuff, it falls under this branch of financial instruments called derivatives. They basically derive their value from the underlying token. But people love derivatives because they let you go. They let you do a few things. For example, they let you go short. You can bet against the price going down. You don't actually have to hold the asset, which means you can trade the price without the regulatory concerns for some industries to actually have to hold ETH, for example. They give you leverage. For every $10 the price goes up, you can make $1,000 if you're 100x leveraged, right? And they let you hedge. They let you do stuff that you can't do when you just buy ETH. So people care a lot about derivatives. And you may have heard of perps in crypto. Now, why are perps so popular? Well, for one, there's one perp contract for every market. So they aggregate liquidity. They're easy to access. They're available in so many places. They're directional, which makes them very simple. You either go long or you go short. You bet the price goes up or down. And the leverage is just a slider. You can go from 1x to 20x or more sometimes. And so it makes it really, really easy and simple if you're betting directionally. But I do include this interesting chart from CoinGlass, which shows the open interest ratio between perps and options in crypto. And at one point, the open interest in options actually surpassed the open interest in perps. There was more open interest for crypto options than there was for crypto perps and futures. And so this is centralized and decentralized exchanges. Of course, that ratio has kind of fallen, but it still sits at around 60% for Bitcoin options. So there is a significant amount of options open interest compared to perps. Interestingly enough, I think options are kind of catching on a bit more than people might think. And with the recent Deribit acquisition, things are going in the favor of options. So let's talk a little bit about why options are cool. Why not just use perps? Well, let's see. First of all, yeah, Deribit acquisition by Coinbase, huge. I think the biggest acquisition in the industry. Another proposal by Synthetics to acquire the DeFi options protocol Derive eventually failed, but it did make big news. So lots and lots of options hotness going on. Why options? Well, here's a huge chart that I won't go over all the nuances between perpetual option, perpetual futures and options. But the key thing here is options are more flexible than perps. It's kind of like if you had a car that you could only step on the gas pedal at 100 miles an hour or 0. That would be like a perp. You can either push a button and it goes 100 miles an hour or 0, right? Super hard to control. Not very forgiving. If you crash, you're going to go off. Now, options are like a car where you have the gradualness of actually stepping on the accelerator. You can go from 0 to 100, but you could also go 50 miles an hour, 20 miles an hour, 75 miles an hour. It really provides that flexibility, which lets you tune things to however you want it. You can still go 100 with options if you wanted, but you don't have to. That's the great thing. Some other key points. So volatility. You can bet on volatility with options. You can't do that with perps, which means if the market is sideways and it's just trending, it's not trending. It's just moving sideways. You can take advantage of that with options. You can make money in those markets, whereas you can't really do that with perps. Cap downside is protected. It means that if the price moves massively in the wrong direction, when you hold an option, you're less likely to get liquidated and you have protection. Perps don't offer that same type. They're much more likely to get liquidated even if just one candle, the wick, hits the bottom, liquidated instantly, right? Options, that's not the case. One other cool thing, synthetic perps. You can make perps with options. You combine a call option and selling a put option, and you actually get a perp. So all squares are rectangles, but not all rectangles are squares. Same thing here. And the key point with options trading is a different mindset. You can make money when you're wrong. You can have flexibility and gray area. Even when the price moves the wrong way, you can still be earning overall. And we see this all the time on Panoptic, where the price has moved the wrong way, but people have earned more premium than they have lost in the price movement. So very, very forgiving as far as options go. Some big reasons to explore options and really consider the big wave of options hitting the industry. So let's go back to the option concept. And the reason why I'm going to bring this in is because it's all going to tie back to those original questions that I posited about LP. What price range should I choose? What fee tier should I choose? What is impermanent loss and how should I manage it? If you can think in terms of an options trader, those questions are going to get answered in a totally different way for you. So if you just hold with me, we're going to go over some key kind of option concepts here. All right, so let's go into the option concept. We have premia expiries, delta, gamma, and implied volatility. Starting with the first one, premium. This is the income you normally receive for selling an option, and you get it up front in TradFi. Now, in Panoptic, it's a bit different, or LP positions. Perpetual options have a streaming type premium, which means you receive nothing up front, but as long as your position's in range, you get these fees every block, and it pays out. It streams out to you. So when it goes out of range, it stops streaming. You stop getting more, and then it could go back in range, and then you earn a bit more again when you play this video again. But you could think of it kind of like a funding rate that takes place every block. The funding rate happens, you get paid the funding fee, and yay, hooray, right? That's how the premium works. Expiries of an option. This is typically how long you have until the option becomes like useless. You can't use it anymore. But as far as an LP position goes, that's perpetual. They never expire, but they do go out of range. And so if you look at the price of ETH, for example, the price wiggles around, and it can take less than a day for the price to move 2% or more. And it might take a bit more than a day for it to move 3%. And how long would it take to move 10%? You know, in this chart, it took 5 days and a half. So we're going to ask this question, you know, how likely is the position to stay in range? When's the first time it's likely to go out of range, depending on how wide your position is? And using some math, there's some, I won't show you the code here, but there's some math, there's some Medium articles on here in our docs about how you can kind of map how wide your LP position is to how likely it is to go out of range. And so if we assume 50% volatility of ETH, we're going to see that a 1% wide LP position, that means you LP 1% above the price and 1% below the price, is likely to go out of range in about an hour. Pretty quick, because ETH moves a lot. It has a high volatility. And if you do a plus or minus 4%, that's going to take about a day. And if you do even wider, 13%, it's going to take a week. So anyways, we list this out table-wise, and you can map these concepts of like, kind of put an artificial expiry on this LP position. It's almost like it goes out of range. It's no longer good type of thing. So that's how we can think of expiries on top of LP positions. Now, delta. Delta is a very important concept in options trading, and it basically indicates how sensitive the options price is to the underlying asset, which means if the delta is 1, for example, and the price of ETH goes up $1, then you're going to make $1. But if the delta was 0.5 and the price of ETH went up $1, you're going to earn 50 cents. So the delta is how exposed you are to the asset. If you short a perp on 5x leverage and the price of ETH goes up $1, you're going to lose $5. Your delta there is essentially -5. And so a negative delta means that you want the price to go down. You're betting on the price to go down because that means you're going to make money. Price goes down, you make money. It's the opposite relationship. So this is how the delta is. It's typically expressed from negative 1 to 1 or 0 to 1, you know, positive or negative. If it's positive, you're bullish on the position. If it's negative, you're bearish on the position. And if it's 0, you're neutral, meaning this is this whole concept of delta neutrality. You may have heard delta neutral positions. The price moves, your position doesn't. You're unaffected by the price moving, essentially. So delta basically tells you how exposed you are to ETH price. And this is going to be a new concept if all you do is buy and hold ETH, because your delta would always be 1 on Coinbase. It's going to be the price goes up 1, you make $1. Price goes down 1, you lose $1. With options, you can choose your delta, which means that you can choose how much exposure you go. You can choose to be bearish on the asset. You can even choose to be neutral on the asset, so that if anything happens, it doesn't affect your portfolio. So you can learn more about this, of course, on our website. Gamma is the second order Greek, and this is like, how does the delta move when the price of ETH moves? So delta is not static, it's dynamic. It means that when your delta might start out as 0, for example, you might be delta neutral. But then the price of ETH moves 1%, and suddenly your delta is no longer 0. Your delta has changed. your exposure has changed. That is what gamma measures, is how fast does your exposure increase or decrease when the price moves around. If this sounds confusing to you, it's because it's second order logic. It's like the derivative of a derivative. And it's also a reason why impermanent loss can be confusing as well, because I'm going to posit later that impermanent loss is related to this gamma thing. But visually, you can think of it as just like the slope of your payoff curve. So let's actually dive in to the Panoptic UI, because I think that's going to explain these concepts a little bit better here. I'm going to pull up the trade page on app.panoptic.xyz. So here you can see there is a position kind of strategy builder, and we can start with an LP position. This is, by the way, an LP position. We call it a short put, as we learned earlier. And the delta here is this triangle. This is the Greek symbol for delta. So actually, if you see here, the delta is actually 1. And the reason for that is because, I should make sure this is, but yeah, the reason for that is because this has a slope of 1. The delta is the slope. It's your exposure. But if I were to move the strike price all the way down here, suddenly you'll notice that the delta is now 0. And the reason for that is because the slope is flat. If the price moves, you're no longer making or losing money. This is kind of like when the LP position turns into all USDC. The price of ETH doesn't affect how much you're earning or losing. And anywhere in between, the delta kind of fluctuates between 0 and 1. So here the delta is closer to 1. You have a lot more exposure. Here, the delta is 0.09, is closer to 0, and you have closer to no exposure. And you can kind of go halfway in between. A delta of 0.47 is kind of like half and half. The slope is half. That's the delta. Now, the gamma is how curvy this object is. So you notice like this position, for example, is very, very gradual. It takes a long time for the delta to go from here, which is 1, all the way to here, which is 0. Whereas for a position that's very, very tight, this is like an LP position that you LP plus or minus 1%. The delta goes from 1 over here, and it just takes a little bit of price moving for the delta to go to 0. And so this has I believe, a very small, high gamma compared to this wider position that has very low gamma, because the rate of change of delta is a lot more gradual and smooth compared to a thin LP position where the rate of change of delta is going to be really fast. So that's how gamma is. It's how curvy your thing is. This is not very curvy. It's almost like just a kink. Whereas this one's very, very curvy. So that gamma is very gradual. Okay, back to our slides. So delta and gamma, hopefully that gives you a little bit more of a visual kind of understanding of how these option Greeks work. So we're going to dive into the last concept of options that I'm going to talk about, which is IV. Implied volatility is a very important concept. It comes from the Black-Scholes formula. It's basically showing that how does the market think about the future expectations of volatility? The volatility of ETH might be 50%. It fluctuates, right? But if things are about to get crazy, right? We're not sure if tariff number 7 is going to get placed tomorrow or not. Then we're not sure what the volatility is going to be in the future. And we might predict that, hey, ETH volatility could go up to like 80%. And that's what the IV is saying. The IV is a number. It's like 80%, for example, and it's saying what the market thinks is going to be the volatility of the asset moving forward. It's called implied volatility because it's implied by the prices of options. You can basically back out from all the options data what the market is collectively thinking about the future volatility. And the cool thing is every Uniswap pool has one of these IVs, and you can basically figure out what the IV is that the LPs are saying on Uniswap they think the future volatility is based on, 1, how much swap volume is coming to the pool, 2, how much liquidity is being provided in the pool, And three, what is the fee rate of the pool? That lets you back out this IV. And so we do show this, and I'll show you again on our markets tab. You'll see different IVs here under the Uniswap column. That's all based on basically the Uniswap data. So this is actually independent of Panoptic, and it's purely a Uniswap metric that we've kind of explored. If you want to learn more about this, check out our article called New Implied Volatility Formulation on panoptic.xyz/research. So the whole point is, as an options trader, the way that you think about things is now in terms of volatility. It's no longer prices for a lot of people, which means if the market thinks that the volatility is going to be extremely extreme in the future, that means IV high. That might be a time where you sell an option. And if it turns out the volatility was a nothing burger, nothing crazy actually happened, and volatility was only 50%, ends up only being 50% in the future, that's the realized volatility, the volatility that actually happens. So if the predicted volatility ends up being higher than the volatility that actually takes place, that's when an option seller makes money, because they were betting that the market was overpricing volatility. They were irrationally scared, or they were wrongly scared, over frightened. And so you sell an option, turns out you're right. Things weren't as scary as the people thought, and you make some money. That's kind of an intro to how you can think of options trading in terms of volatility. Okay, and there is this kind of component to how Panoptic implements options, which lets you kind of increase or decrease the LP fees that you have to pay based on this volatility. So it does impact the IV of an LP position, but I won't go into too many details about that. We're going to review LP equals options. So we talked about kind of these different option concepts. Let's connect the dots. So first of all, we have impermanent loss. This is similar to gamma. The reason is the impermanent loss is kind of like the curviness of the curve. When you do a really tight position, you're going to see a lot more impermanent loss. You can do a really wide position, you see a little bit more gradual type thing, less impermanent loss. And so your gamma, impermanent loss is this loss versus hodling. If you had, instead of LPing, you had just held on to your tokens, how much more would you have made, or how much less would you have made? X the premium and the fee that you're getting from Uniswap. But the key point here is that actually you can think of impermanent loss a little bit differently, and it's just like, how gradual is my exposure changing? How sudden is my delta going to go from 0 to 1, and suddenly I'm no longer delta neutral? Option traders don't really care about impermanent loss. They care about their gamma. They care about how fast their exposure is going to go in a place that they don't want it to be. And so there is a big connection here of thinking in terms of gamma when you LP. It's how soon am I suddenly going to become 0 delta? How soon am I going to become -1 delta? Does the price have to move 1% or 5% or 10% for me to suddenly become more exposed to ETH than I would like? This is gamma. As far as the LP position's width, you can now think of this in terms of expiries. So instead of thinking like, hey, should I do a plus or minus 2% wide position, or should I do plus or minus 1% wide position? Obviously, the narrower position is going to be more constraint or more fees, but it's also going to go out of range faster potentially. And so we should look at mapping this to an expiry of like, hey, it's about a day versus 2 days, or 5 days. So you can think in terms of expiries when you LP. When you look at the price range of an LP position, sometimes people calculate exact price range, like 2880.5 to 3311.2. I would like to posit there's another way to think of it, and that's the delta. Instead of just thinking like the exact price that you wanted at, you could just think of it as how exposed is my position to the underlying, right? So if we do, sorry, a LP position, if I choose, it's kind of showing up in small black numbers, but it's 2130 to 3443. I could do it there, 2130 to 3443, and that would give me a delta of 0.58. So I'm exposed about 58% to the price of ETH. But I could do a different price range, 1758 to 2841. And here my delta is actually much smaller, so I'm much less exposed. And so when you're trying to decide, like, should I LP above the price or below the price or kind of in the middle, like really the key thing to think about here as an options trader is what's your delta? What's your direct kind of exposure to the asset? Right. So if you LP way out here, then obviously you're out of range and you have zero exposure. But if you LP here, you've got 0.47 exposure. So that is one. Oh, sorry, I realized I was sharing the wrong tab the whole time. let's do this one more time for the visual learners. So when you're choosing an LP position, you could LP between 2030 and 3281. That would give you a delta of 0.47. But you might want to LP at 1676 to 2708. So you're mostly LPing below the current ETH price. This would give you a much smaller delta, 0.09. You have about 9% exposure now to the price of ETH. Whereas if you did it in the middle, you have about 50% exposure. And if you do it kind of above the price, you have almost 100% exposure. So what I'm positing is that you can think in terms of the delta of a position instead of, or in addition to, the actual price range that you're LPing at. And finally, the pool profitability. So when you're asking, should I pick ETH USDC 5 bips pool, or should I pick the ETH USDC 30 basis points pool? Which one is better? One metric we can look at is the IV, because the IV is going to tell you how much swaps are coming in, but also how much liquidity is there to absorb those swaps. And obviously, as an LP, the less liquidity there is, the better for you, because you're going to get a higher amount of share of fees, but also might mean that there's less volume flowing into the pools. So then you're going to get less volumes to take fees from. So there's this balance, and IV does a great job of kind of combining the two opposing forces of swap volume and liquidity being provided. You get this number. It's a percent, it's annualized. So here we see in the ETH USDC V3 pool, that's 0.3% fee, about 41% IV. And then you could look at a different one. Here's the 0.05% pool, and it has a 42.86% IV. So actually slightly higher. So technically, this 0.05% pool has been doing a little bit better by a little bit. At least it's been getting a little bit higher IV, which means LPs are earning a little bit more in this pool slightly. So that's a good way to actually gauge and balance out the effects of volume versus liquidity. Which pool is better? IV kind of tells you that. So this is kind of the big picture connection of, if you start thinking in terms of an option trader, think in terms of curviness, exposure, expiries, implied volatilities. This kind of changes the game. It provides a whole different new lens when you LP. No longer are you asking questions about which price range you want it at, but rather how much exposure do I want? You're less confused about this theoretical loss against hodling and more some concrete concept of, what is my gamma? Do I want a lot of gamma or do I want a little bit of gamma? Do I want to stay delta neutral for longer and hedge less, or do I want to stay delta neutral for shorter and have to hedge more? These are the types of questions that you could be asking as an options trader and bring that to the table when you LP. So the key point here is that we have four very, very different looking images. But in the end, they're actually all kind of the same. An LP position is LP position is bullish. When the price goes up, you make money. When the price goes down, you lose money. Don't get it confused with impermanent loss, where you always lose money. When you take your money out of Uniswap and you pay your taxes, you do have to pay money when the price goes up because you actually made money. This is a realized actual loss, not a theoretical loss. And this is the same thing as the put option because it behaves very similarly. And we've gone through kind of the reasons why LP positions and put options are almost the same thing with different flavors. One's perpetual and one's not, right? But very similar things. And so I want to get back to a key point of the slides, which is one of the biggest differences between LP positions and options is that um, you can't buy an LP position. There's no way to buy an LP position. Now you could do this kind of annoying thing, which is it's an NFT. You could offer it on OpenSea and say, "Hey, I'll sell you my LP position for $10. You can buy it from me, and you get it. And then let's say you lend it out. Maybe it's not OpenSea. You lend out an NFT on some lending platform that is compatible with NFTs. Someone borrows it, and then they pay you this funding rate or whatever, borrowing fee, and then in a few days later they give it back to you. So you could kind of do this thing where you loan out your LP position over the counter and allow people to buy it. It's very cumbersome. There's no way this is going to take off because it's so niche and so low liquidity for that way. So you can imagine, though, kind of the concept of how you would recreate basically Panoptic. So Panoptic lets you do this, provides a wrapper, which basically turns non-fungible positions into semi-fungible positions to aggregate liquidity. But that is what Panoptic does. It lets you buy LP positions. It lets you truly treat LP positions as options because that lets you now buy options. Instead of LPing, you can short LP positions. You can make money when the volatility goes up. You can do these things called straddles that are really cool, and I'll show you here on the trade page. You can do these things where it doesn't matter which way the price goes. You're going to actually profit if the price moves enough. So this is kind of a mind-blowing thing when people first get into options, that you can make money whether or not the price goes up or down, right? So it's this thing called a strangle or straddle. So you see here, if the price moves significantly upwards, you're in the green, you make money. If the price moves significantly downwards, you also make money. It's where the price doesn't move where you're in trouble. So nothing's too good to be true, but you're really betting on a big price movement. You can do all sorts of stuff when you enable the buying of LP positions, and that's exactly what Panoptic lets you do. It lets you short LP positions, which you have to do in the options mode, but it unlocks a whole new window of LPing where you can LP and have impermanent gain, and you can have gain versus rebalancing, and you can do stuff like create synthetic perps. You can trade perps on Uniswap. Like who would have ever thought you could trade perps on Uniswap? But there's a whole world and a can of worms to open. That's Panoptic. If you want to learn more, check out our live streams. We do this every week. We have lots of great resources that you can read up on to kind of get you started. docs.panoptic.xyz is a great place to start, where you can learn more about how LP positions and options all interrelate and how you can actually start trading them. We do have a trading competition coming up on Monday next week. So stay tuned for more details on that. That's a great way to practice, kind of get used to some of this new terminology. You can try out different deltas, different gammas, different expiries, and test them out. You can test it out with just a few bucks on Panoptic. So that's nice. We're on Base, we're on Unichain, we're on Ethereum. Low gas fees on some of those L2s, let you experiment. Remember, nothing I said here is financial advice, so please do your own research. But this is the end of today's segment. So hopefully you learned something about LPing. And if you came here as an LP, hopefully thinking in terms of an options trader can elevate your LP game. It can help you think of things that you may have never thought about before, such as the payoff curve of an LP position and how much you're actually going to make or lose when the price of ETH moves. So welcome to our live stream, and thanks for participating, joining in, and appreciate everyone who tuned in today. We'll be back. It is a holiday here in the U.S. where most of the team is based on Friday. So we'll be back on Monday. So stay tuned. Next Monday we'll have some new live streams where the intern portfolio goes over their options trades, and also we'll see the start of a new trading competition with more detail to be announced there soon. So thanks everyone, and take care.